Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. I hope you all are having a great start to your weekend. I want to thank you for tuning in to the KE Report weekend show. And on this weekend show, boy oh boy, we have a lot to talk about when it comes to some pretty important U.S. economic data, i.e. the jobs number that we saw this week, some central bank meetings to recap, including the Fed, and some very important market moves, especially at the end of the week, as, boy, oh boy, we started to see a bit of a meltdown almost across the board. First half of this show is going to be focused on recapping all of what I just said, and in the second half of the show, switch our focus a little bit more to the resource sector and ask a fund manager what opportunities he sees in underlying commodities stocks. Kicking off this show, we are chatting with Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. Mark, let's start off with that U.S. jobs number. It was a big miss. Headline number, 114,000 jobs added. I was seeing the estimate somewhere around 185,000 jobs. Unemployment rate rose to 4.3%, which is the highest since October 2021. This seems to be a continuation of something we talked to you about last week, and that is continued weakening data, and a lot of generalists now starting to say, look, this is not looking good for the U.S. economy. Mark, break down that jobs number. How concerned are you about this figure?
Yeah, so Corey, I think that Powell, I thought the Federal Reserve Chair Powell is very clear about this. He says when it comes to the inflation, there's one number that the Fed watches, that the target is the PCE deflator, personal consumption expenditure deflator. And of course, the CPI is a lead indicator for that. But when it comes to the employment data, the labor market, Powell says that there's not just one number that captures it. So multidimensional labor market. And even before today's U.S. jobs data, we've had a series of weak data coming from the labor market. I'm not just thinking about weekly jobless claims, elevated to continuing claims. I'm looking at the employment cost index, which much cooler. That's a measure of wage pressure and non-wage benefit pressures like healthcare costs. Unit labor costs, that's the measure of productivity as well, is embedded in there. What's the cost unit per output? And we saw softer numbers there. From the JOLTS report, we've seen hiring slowing. We've seen people quitting their jobs slowing. It's all signs of a weakening of the labor market. And we've seen some of the surveys like the ISM pointing to weak labor market data. And so I'd say that the takeaway from today's data, the most important thing that I think is going to be in the headlines is that the unemployment rate went up to 4.3%. And part of it is because the participation rate went up. But this, at the end of the day, the important part of the rise of the unemployment is that it triggers what's known as the Sams rule. And she was a Federal Reserve economist, and the rule is something like this. When the 3-month average of unemployment rises half a percentage point above its low point for 12 months, it always signaled a recession in the U.S. Powell referred to it as a statistical regularity. Well, we passed that threshold. And so when we pass that threshold, it sort of just fans these concerns that despite the strong growth we had in Q2, that the U.S. economy is either in or headed for a recession. And this has had a ripple effect through not only through the dollar, the foreign exchange market, but also the interest rate market. I mean, you look at what's happened. The U.S. 2-year note yield after the jobs data fell over 25 basis points. Powell said earlier this week that though the Fed's confidence that inflation is moving back to target had increased, they still weren't quite there yet, explaining why they didn't cut rates at the end of July. I think that the market basically says you might not have eased rates, Federal Reserve. We're going to do it for you. And that's basically what's happened. But looking at one of the largest drops in the U.S. 2-year yield, and not only for this year, but for many years, basically going back to COVID, we're talking about roughly 45 basis point decline in the U.S. 2-year yield. And that's, again, coming after the jobs data, but after the hints from Powell that the Fed was getting, that there was a discussion to cut rates in July, but the clear majority favored waiting. And I think that wait is clearly now that market's expecting. a cut in September, but not just 25 basis points. The market is pricing in roughly 75% chance that the 50 basis point cut to kick off the U.S. easing cycle.
Yeah, Mark, a lot of people are tuning into possibly a 50 basis point cut versus the 25 in September. And to your point on that Psalms rule, I mean, another one of the stats that they use on it is that in a 12-month period, if you see the unemployment rate go up over 0.5%, and we've gone from 3.7 to 4.3, so up 0.6%, that has triggered it. And like you say, a lot of worries about recession now. But the other thing that we've been hearing about is the yield curve steepening and it possibly uninverting in the near future. And if that happens, a lot of people made a big to-do about the yield curve inverting and saying, oh, the recession is imminent. But it's really when the yield curve uninverts that we start seeing more of a recession warning. So with all these things stacking up, do you think that forces the hand of the Fed to actually do a series of rate cuts, or is 50 basis points enough in September?
Well, I think, Shad, that when I say the Federal Reserve doesn't do things one at a time, I put it more like this. The Federal Reserve's policy was set when they feared the economy was overheating. That's no longer the case. It's not just Powell suggested that the economy is just normalizing. And again, I really think that we should think about a soft landing of the economy as the early stage of the end of a business cycle. First, the economy it's growing fine, and then we have a condition where inflation slows, the economy slows, everybody jumps up and down. There's a great soft landing, and then the economy continues to weaken, inflation continues to fall, and we have a hard landing. So to me, the soft landing is just part of that cycle, and that we should be looking for a recession, whether it comes this year, next year. Exactly how they date it is beyond me, but I agree with you that the different indicators that we look at, including the yield curve. Today, I should say after the jobs day, the yield curve is now about 6 basis points inverted still, which is really the least since 2022 when it first became inverted. And I agree with you as well that it's really when the yield curve steepens, that has been positively sloped, coming out of that inversion, that is another one of these recession signals. And so, so I'm concerned about this, but I think that we should expect the Federal Reserve to continue to cut rates. There's 3 meetings left in this year for the Federal Reserve. The market has 117 basis points of cuts discounted. That I'm looking at the Fed funds futures, 117 basis points. And so that's essentially you get the 50 basis points in September, and then another cut in November, another cut in December. I think it's interesting where we're going to go. Just like on the way up, we talked about what the terminal rate is for Fed funds. And now I think we have to think about where's the terminal rate on the bottom. And my first guess, and now, given like our current information set, is that Fed funds are going to say 3.25 to 3.5. And that's going to probably take us well into 2026.
Yeah, series of rate cuts, hey, just like we got on the way up, a series of rate hikes. Now we're going in the opposite direction. But Mark, look, when we look back at economic data, it almost seemed like we were in this stable range. And starting in early 2022 through kind of mid 2023, and then everything's been trending lower broadly. It hasn't been plummeting, but it has been trending lower. But this isn't just in the US. So could we be potentially looking at not just a recession in the US, but a global recession?
Yeah, I think that's what concerns the Federal Reserve. It's hard to imagine how the U.S. economy can continue to, say, grow robustly when our major trading partners and other large economic centers are weak. And I think that goes for the U.S., for Canada and Mexico, for Europe. We've seen a series of weak data. And so, I think that the business cycle, increasingly as the global capital markets become integrated, I think that the business cycle becomes somewhat more integrated. That is, the divergence between economies narrows. And I think that the narrowing of this divergence happens at a lower absolute level of growth. And ultimately, with the U.S. being on the top now, it's going to weaken. And that's really the real news. It's not when a weak country like Japan, for example, or Europe struggle. That's like, I want to say that's why we have airplane accidents make the news, but car accidents rarely do. The U.S. economy weakening like this is new news, really. I think people have been talking about it, but the economic data, including that Q2 GDP that came in just before the FOMC meeting, stronger than many people expected. But that's what happens. Typically, the economy doesn't just like slow down, slow down, slow down, and then tip over into recession. It's usually almost like a V. You're growing fine, and then all of a sudden you're not.
Well, and Mark, just to that point, it's not all in one area either, because there's areas like manufacturing that have been in a recession for 2 years. If you look at the boom bust data, and they've been below 50, but then there's areas like the real estate market that have actually been doing okay. And to your point, the GDP number outperformed expectations at 2.8% growth. That's not nearly as dire as a lot of other nations are facing. But to your point about the U.S., the biggest engine of the world economy, starting to falter a little bit, could it still be the cleanest shirt in the dirty laundry bin? Because look at Europe, look at Japan, and I know China's growing, but they've got their own problems with their real estate markets, the stock market. So there doesn't seem to be any big pockets of super growth on the planet. Could the U.S. still fare better just because, yeah, it's starting to weaken, but maybe not as much as other countries are?
But yeah, to me, Shad, what you point to really is why is the U.S. economy growing so much faster? And I think a lot has to do with our budget deficit. And the budget deficit, the next fiscal year's budget baked in the cake already. And so, yeah, I could see the U.S. economy performing a bit better than the trading partners. But when it comes to the foreign exchange market, I think you have a little bit of a different story. I think that the market is still very long dollars. It's really the cash register for quite some time. And so I think about what happened. Just think about the recent history. Q4 last year, remember, it seems kind of wild now, but people were thinking the Fed was going to cut 6 or 7 times this year. And global interest rates fell. The key though, US interest rates fell, the dollar fell. In Q1 of this year, the market realized they had stated the case, and interest rates rose in the US, they rose globally, dollar rose. So to me, the real key piece here is what happens to U.S. interest rates as far as it goes, as far as it's related to the foreign exchange market. And so I do think the dollar has turned. We've seen a huge move on the yen. That's partly the Bank of Japan raising interest rates, hawkish rhetoric, unwinding of these yen carry trades. But I think that we've probably seen the low for the euro. We got down to almost 107.75 this past week. I think that could be the low for this move. And I look for a retest, maybe 109.50, 110 area. Same thing with sterling. We got down to 127, and I think we get back above 129. We got to look at last year's high, and near 131 and a half or so. So I do think that the dollar basically, the dollar was stretched, overvalued after many years rally. And one of the key legs of it was Fed policy. And if Fed policy is going to change, and now it looks like it's going to change aggressively, I think that's trouble for the US dollar. But just on price level, cyclical move, not the whole de-dollarization story. This is just about where is the dollar going in the next 3 to 6 months, and I think it's going to be lower.
Let's talk about markets then. For investors, if we are in this environment where the Fed is going to be cutting rates, but it is in the face of weak economic data, potential recession right around the corner, or already here, are there any opportunities in equity markets, in commodities, in anything as maybe a safety play as these rates continue to go lower?
So I'm thinking that cash is king here. And I think what the tendency is going to be is that people like myself, many people in the audience, many people who I know, have been waiting for a pullback to buy U.S. stocks. And I'm afraid that's going to lead to like a tendency of jumping in too early. What strikes me looking at the S&Ps is a gap lower that hasn't been filled from July 17th. And then after the jobs data, we have another gap lower in the S&P 500. So we've retraced. It sounds kind of weird because how bloody it's felt in the past week or 2 weeks. But the S&Ps have only retraced about half of the leg up since mid-April. We are still at very elevated levels. And so I can imagine, like, well, what level would I be tempted to begin getting back involved in the equity market? And I'm looking at over time, which seems to have been good value, is beginning to buy near the 200-day moving average in the S&P 500. So you say, well, where's the 200-day moving average? About 5,000 now. So all that big gain that got us up to about 56.70, I think we have to unwind that. And that 5,000 level in the S&Ps is not, it still is pretty elevated. I remember when we crossed that, I think we were talking in that time when the S&Ps got above there, I was cautious, and yet it left 11, 12% on the table, and here we are, I think, coming back to that level now.
Yeah, Mark, you took the words right out of my mouth. I was going to say the 5,000 level used to be something people were dreaming about, and now people are crying in their beer about it because it's pulling back to 5,000. But these are still very elevated levels for the market indexes. And even though there's been a rollover, it's still from such high levels, from record high levels, that we're still in kind of nosebleed territory historically. The other thing that's really worth noting is the volatility has really ramped up. If you look at the VIX, it was stuck in the 12 to 15 range forever. It seemed like for months and months and months. And then just in the last couple of days, it shot up. I mean, earlier today, it was up 55% in one day. It's only up 42% at the time of this recording, but we've seen a huge rise in volatility, which means people are putting on hedges. They're hedging their bets a little bit. But to your point about people jumping in a little too early, do you think that this has some legs to it as far as this downward move in the markets, even beyond the 5,000 level, and that maybe people really need to let it play through before they start pulling money in off the sidelines?
Well, yeah, I think that, of course, I was just talking to someone who was talking about like trying to catch a falling knife. And at what point is the stock market is the sell-off so attractive that it's like you can't help but really want to buy? And I suspect that you're right that there's nothing magical about the 200-day moving average and at 5,000 level, that ultimately it wouldn't surprise me to go back down. I mean, January's low for the year is about just below 4,700. So I think that as one begins putting money back to work in the stock market, you don't put it back in all at once. You bleed it in, maybe dollar cost average it in, beginning maybe at the 200-day moving average, but prepared for it to fall a few more percentage points for sure. And this is still a relatively elevated valuation measure. And as we go through we're getting through the earnings season, and it's quite surprising to me about the number of companies that are missing on the revenue side. What caught my eye was McDonald's saying that same store sales had actually fallen for the first time since 2020. McDonald's, I thought, was always this recession proof kind of thing. They've been cutting prices. And so when I saw a decline in same store sales, to me, that's another one of these recession signals.
Seems like a recession is finally coming, one that we've talked about for a couple years. Now it might be here. What does that mean for the commodity markets then, Mark? Because we've seen most commodities outside of gold, which just hit all-time highs and has reversed a little bit from that level, but still up in the 2450 plus range. Are all commodities going to struggle from here because of the fact that we're entering a recession, even if the dollar keeps dropping?
So I think that this idea that commodities have to go up in a weak dollar environment is a bit exaggerated. I think that at least at where we are this phase, I think that focuses on demand. And we were talking about oil before we began recording, and I think oil is a typical like story here. You got a weaker dollar. You have Middle East tensions again, where the Iranians and Israelis look like they're really coming to blows in a more serious way, in a way that could escalate. Oil did pop up initially on the news, but demand side seems to be what brought us back down. And we're finishing the week with September WTI off on the week, off about 4.5%. And we're trading near $73.50 a barrel now. And we tested, whatever it was, 82, $84 last month. And here we are, despite the likely escalation of Middle East tensions, demand side is really what's pulled us down as people think not only recession in the US, but we've had weak demand in China and weak demand in Europe and Japan.
Well, Mark, we were talking about the commodities a little bit before this call. We were talking about how most everything was rolling over. And yeah, it is surprising to see oil rolling over with Middle East tensions and with a weaker dollar. But gold was getting a safe haven bid earlier in the week, midweek, Wednesday and Thursday. And that's when it spiked up to all-time highs. And it seemed to be getting a bid in tandem with the dollar and with bonds. So it seemed to be a safe haven play. But we were talking off mic that now it's rolling over on a day where you'd expect it to be up. Is it possible that people are going to take profits in anything that's up right now to backstop all the positions that are down?
Yeah, I think that's sometimes typical of how the markets react. I think gold is really like a bit schizophrenic. On one hand, it's a safe haven. People buy it when the world looks like a mess. They think it's a hedge for inflation. But other times it acts like another risk asset. And I think that we've morphed from a safe haven back to that risk asset where everything is selling off. And I think that's what happens too for a lot of large pools of capital. They take a loss in one area, and how do they fund it? They take off a winner as well. Even though the logic, right, we're told, especially on the retail side, that to let your profits run and cut your losers. But sometimes I think people who are making decisions book their winners to help cover their losers.
Mark, looking ahead, is there anything the rest of this summer that could potentially change this overall quite negative narrative for the markets and for the economy?
I don't see the economic data in the next couple of weeks with the heft to do so. I think that so besides the U.S. inflation report towards the middle of August, I think that the Jackson Hole symposium at the end of the month is the next big event for the Fed to clarify where they stand. So yeah, I just don't see the data having this sort of gravitas to change people's sentiment. This is going to take a while, just given the broad indicators that we're looking at on the labor market, which is ultimately deflationary. So my best guess is nothing's going to turn us around, but I do think that there is a pain trade out there that could take place as early as Monday, and that is given this huge decline in interest rates, sell-off in stocks, this recessionary fear. One of the things that triggered it in the U.S. this week, besides the jobs day at the end of the week, was the softer than expected ISM manufacturing. Well, on Monday, we're going to get the ISM services. And I think the pain trade is for that ISM services to be a bit stronger than the market expects. Back in June, it fell below 50 at 48.8. I think that sort of overstates the case. And so I suspect that we could get a firm number on Monday, and that would help the markets consolidate and pull back from the world's coming to an end type of cliffhanger that we're having today.
All right, Mark. Great chatting with you. Thank you very much for breaking down all the important data and news from this week, as well as this market meltdown, in a sense, to end this week. Boy, oh boy, the end of summer might be pretty rough for investors, but it's been a pretty good run over the last couple of years. Now, finally, that recession that everyone's been waiting for might be very much around the corner, and that's pulling everything lower. We'll see if there is a bottom anytime soon. Mark, thank you again for taking time with us on this weekend show, everyone. Remember, you can check out Mark's website, Mark to Market. That will be posted in the show notes. Everyone, stick around. We're going to be right back with Matt Geiger talking commodities stocks.
Thanks, Corey. Good luck, everybody.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report after those first two segments where we really just dissected and recapped all the data, all the news from this week on more of a macro front and central bank front. Now we're moving with focus into the resource sectors. We're chatting with Matt Geiger, managing partner at MJG Capital. We're going to be talking about some of the recent M&A in the resource sector and also getting a quick recap of how Matt's fund has done so far this year. And the big question a lot of our listeners are asking, when will the junior sector finally get moving and what are the catalysts for that? So, Matt, let's talk about the MJG fund performance in at least the first half of 2024. We've talked a lot about how well metals prices have done, especially in the first half of the year, or even that second quarter. But let's talk more what the fund has experienced here. Matt, you broke down a lot of it in your investor letter sent in early July. Take us through how the fund did first half of this year.
Thanks for having me back on the program here, Corey. Yes, we put up the mid-year investor letter in early July. That can be read at the MJG Capital website at mjgcapital.com. I was pretty pleased with our performance in the first half of the year. We were up 14.5% through June month end. And as you know, it's been a really actually tough period for the juniors despite metal price increases that we've seen year to date. So performance was roughly quintuple that of the TSXV, at least over that period. And as you know, the MJG fund is very heavily weighted towards the junior end of the market. We have a $30 million median market cap, and only 4 of our 20 current positions have a market capitalization north of 100 million. So very much weighted to the junior end. So I think for folks that are following the mining industry closely, they'll be somewhat impressed by the performance over the period, probably less so for generalists as they watch the S&P 500 continue to truck higher. The S&P was up just 15% and change, so a little bit less than 1% more than the fund over the same period. And as mentioned, the first half of the year was characterized by metal price breakouts between the 2 bellwether metals, as I described them, gold and copper. Gold was up roughly 15% through early July, copper close to 20% over that period. But the miners really writ large have failed to show any leverage to these metal price increases whatsoever. The big producers at best kept pace with metal price increases, while the juniors, as mentioned in the first half of the year, were marginally positive. So over shorter time horizons, it's not super uncommon to see these dislocations between metal prices and the underlying miners. But at some point, this will have to be resolved, either through sharp pullbacks in the prices of these underlying metals, or with the miners playing catch up, and the juniors included in that. And I mean, historically, mining equities will exhibit 2 to 3x price leverage to their underlying metals. That was certainly not the case in the first half of the year, but I've seen no evidence that over the longer run here that this relationship has broken. So I'm actually quite bullish, assuming metal prices stay put, if not move higher on where we sit, both with the miners generally and then also with the juniors more specifically.
Well, Matt, just to that point, as far as the mining stocks tracking the metals, they generally do, and there's generally that torque to the upside or the downside depending on the direction of the metals. But we were just talking off mic that when you have an exploration company that's had drilling success or a development company that may have had a key resource update or economic report, they can actually move counter to their underlying commodity. You've mentioned on the show some of the positions you have that have done quite well, really in the spite of a lot of the other parts of the sector not moving. So maybe speak to how you've positioned in not really the metals, but really the projects and the people.
Well, that's right. I mean, in terms of our performance for the first half of the year, it was driven largely by 4 of our positions. So we'll say 20% of the portfolio. We had 4 names, each of which were up by over 50% year to date through the end of June. So it was certainly not a rising tide lifts all boats scenario by any means. It was a few specific positions who did very well due to company-specific catalysts. And as I've mentioned on this program before, the MJG investment philosophy is to invest in companies where even if metal prices stay flat indefinitely, there are company-specific catalysts, whether it's a drill program, whether it's a first economic study, whether it's success with permitting, whether it's M&A potentiality, where we can see gains, hopefully 2x or more in the current share price, even without metal price moves. So I'm far from an optionality investor. Obviously, if metal prices move in our direction, then that's wind in our sails. But by the same token, I look for opportunities that don't require the gold price to go up 20 or 30%, or don't require $8 or $10 copper for these projects to make sense on paper. So that's something that I've stuck with really since the fund's inception. I think that's the smart way to go. There are some investors out there that are particularly attuned to the market cycles and can well time metal price moves. I do not fall into that bucket. I'm bullish on metal prices longer term here after 10 plus years of significant underinvestment in exploration development and in mine development. I'm assuming flat metal prices when I look at each of our investments, and would love to be surprised to the upside, but I'm not depending on that by any means.
Yeah, it's a good strategy, Matt. Plus, it provides maybe that extra kicker to the upside. But again, not all these stocks are taking part in this. This looks like a bull market for metals, and the breakouts we've seen in gold and even copper, you can argue, are very bull focused. But why aren't these stocks all moving higher? Why aren't we seeing more investors come into this sector? What's the catalyst going to be for not just the juniors, but truly the juniors to get moving?
Well, the optimist in me sees the lack of reaction from the juniors as actually good news and a harbinger of a longer duration in terms of this bull market. When you see the juniors react immediately to metal price moves, we might be looking at a shorter term move here in the space at large. But one could argue, and we'll see looking back on 5 years from now whether this plays out. But this is largely how it's supposed to occur. The metal prices move first, the money trickles into the larger producers. the larger producers start to outperform metal prices, and then it's game on for the junior space. So I wouldn't rule out that this is playing out properly. I understand the frustration amongst junior-focused investors. I'm feeling the same, but we need to focus on longer-term time horizons to have success in this space. In terms of the potential catalyst to get the juniors moving here, I see a number of possibilities. I don't know exactly which one. One is just another up leg in metal prices, really stirring the animal spirits of speculators to come into the miners and then that trickling down to the juniors. And we may be seeing this with the gold price, actually, which I'd argue is the ultimate bellwether metal, with the gold hitting another all-time high just a couple weeks ago. And I think a break above 2,500, and it could be game on for the miners. So another leg higher in metal prices is one potentiality. A second would be metal prices that we've seen today, with gold up 20%, copper seeing a pretty significant pullback since late May, but it's still up double digits on the year. And it's possible we'll just need to see these higher metal prices reflecting in the earnings of the major miners for 1 to 2 quarters, and for generalists to realize that these companies are gushing cash and to wade back into the mining space after taking years off with most of the attention and affection, I should add, for large cap tech at the moment. So that's another possibility. Another would be a world-class discovery to come out of the blue. This, of course, could happen at any time, and it could supercharge the whole space. Obviously, it didn't end well, but a prime example of this would be going back to Bre-X in the mid-90s. And that single quote-unquote discovery drove a 2 to 3 year bull market in juniors as people's senses of greed really came to the fore. And just on that note, the BBC just came out with a really good podcast, The $6 Billion Gold Scam. It was released originally in May, and I think the final episode has just come out. So even for those well-versed with the Bre-X story, I found that to be a fascinating listen. Would highly recommend it. And then I'd say the final potential catalyst, and probably the most likely at this point, is increased deal-making activity. Obviously, just yesterday, we had a huge M&A deal with the Filo takeover by BHP and Lundin Mining. And then that also overshadowed a deal between Integra and Florida Canyon Gold. And just a couple of weeks back, we also saw Agnico Eagle put a large chunk of change into Foran Mining, followed shortly thereafter by Zijin Mining, making a large strategic investment in Montage Gold. So even though the summer doldrums are in full swing and it's been slow on the news flow front for a lot of these companies, I would argue it's actually been very busy on the M&A front. So I'd say increased M&A is probably the best bet for the catalyst that will shake the juniors out of their doldrums. But honestly, from an MJG fund perspective, we're investing over long enough timelines where I really don't care which of these potential catalysts, actually manifests. And I feel that it's coming for the junior space, absent a larger breakdown in the broader market, which is kind of the one potential thing that could throw cold water on the space in the near term.
Well, Matt, out of those 4 catalysts you laid out, which were great, by the way, let's dig in a little bit further to the M&A. Let's pull on that string for a second, because really the year has gotten off to a pretty big start. I mean, we were tracking, I think, over 14 M&A deals in the sector just by the summertime, by June and July. So it has been active, and that gets money circulating in the sector. So as people are in a position where that's taken over, they then take that money and rotate it into new names. Do you think that kind of energy of the money circulation and rotation is what we need to see more in the space? And are we going to see more of the juniors taken out now? Because we have seen some bigger deals amongst some of the larger players, but when do they actually move down into the true juniors?
Well, I think that's right. I mean, I think a big sale like we saw with Filo just yesterday can be psychologically energizing for participants in the space, because a whole lot can go wrong, and many of us have experienced that. But occasionally we do see these rags to riches stories, and Filo's certainly one of them, with share price going up close to 20x from when the initial discovery was made to now this exit likely to be at $33 Canadian per share. And in terms of the Filo deal, I mean, we're talking $2.8 billion in cash finding its way into the hands of Filo shareholders. And this is really a massive liquidity event for many of the key players in the mining space more generally. Again, this cash transfer won't happen overnight. We're talking about the deal closing in Q1 2025. But over the next 6 or 9 months, we're going to see significant liquidity come into the hands of some big investors in the space. And really, if only half of this cash consideration is redeployed into mining equities, we're talking about a wall of money, really, $1.5 billion to be deployed over the next 6 to 9 months. And it's likely that a good chunk of this will go into exploration and development stage names, which is exactly the stage that Filo was at. So I don't think one can underestimate the potential significance of this deal for the junior mining space at large. But I also don't think we should expect each of our holdings to be up 10% overnight.
Yeah, fair enough. Be reasonable about it. But let's talk about that Filo takeover. BHP, Lundin Mining, combining here to form a JV. They're going to have Filo del Sol and the Jose Maria property, both in the Vicuña district in Argentina. This is still going to take a while for these projects to develop, but these are massive projects with two companies that have money to back them. What do you think it means for the Vicuña district in Argentina? Are there other opportunities there? And what do you think about the potential of these two companies moving these into production? What's a time frame?
Well, there's a lot going on here, and so I'll try to share a couple points that maybe hasn't been shared already by many of the market commentators. I mean, this is obviously one of the biggest deals of the year for the mining space. The first is taking a step back. This is a good reminder that a metals project needs two things to work in its favor: grade and tonnage. Grade and tonnage, grade and tonnage. Many projects have one or not the other, and many more have neither, a grade or tonnage to be an economic mineral deposit. Filo del Sol obviously has both of these, and to a degree that despite many hairs on the project, it's extremely remote with very little infrastructure to speak of in the region. There's an acute lack of water, which is going to be a clear focus as the company develops this asset over the coming 10 years. The deposit straddling a border between Chile and Argentina, with good chunks of the deposit sitting on either side. So that's not going to be easy from a permitting perspective. And perhaps most importantly, there's high levels of arsenic spread pretty uniformly throughout the mineralization there. So there are actually a lot of hairs on this project. This is not going to be easy to develop by any means. But the size, the immense size, and the grade clearly won out at the end of the day. And it was compelling enough for BHP and Lundin to make an offer. And the price tag here, this makes this one of the most expensive purchases of a pre-production mining asset in this industry's history. So grade and tonnage won out at the end of the day, despite some clear hairs on the project. Second point here, in terms of the final takeover price, I know some Filo shareholders are going to be disappointed with the final sales price here, which is at a roughly 12% premium to the closing price yesterday, a 17% premium to the day that the takeover rumors were first announced. I believe this was on July 12th, and a 32% premium to the day before the takeover rumors first circulated in the press. I know there are some Filo shareholders out there that were hoping for up to $40 per share and a 2% royalty to be spun out before any potential transaction took place. That's clearly not the case here. They'll be getting $33 a share and no royalty. But, stepping back, I think Filo management, led by Jamie Beck, obviously with close oversight by the Lundins, I think they made the right decision here to take the money and run. And I say this for a couple reasons. The first is that the project stage had already passed the initial speculative run-up phase that you'll see in the Lassonde curve. And it was starting to inch into the trough, that trough of despair, as a project can take many years, and especially given the size and remoteness of this project. We're talking 6, 7, 8, 10 years of permitting, infill drilling, detailed engineering work. Like the sexy phase of the mineral discovery has passed. And so I think management recognized that and decided now was as good of a time to exit as any. And I think the second point here is just due to the scale of the project, both the size and the initial capex it will cost to build, and the market capitalization of Filo itself, there are really only a handful of potential suitors for this project. You could count them on one hand. And really, since BHP stepped into the fray in the spring of 2022 with their 5% strategic investment, they were always going to be the group. If any group took it over, they were always going to be the group that made the move. So it seems like the talk of the royalty spin out really forced BHP's hand, with Lundin Mining coming along for the ride. And I think that's why we saw the deal occur at this point.
Well, Matt, when you think about the size of copper projects and how much capital is needed and how much experience is needed to bring those mines on, like you say, there's not a lot of suitors for a lot of these companies, but this was creative in that you have two companies working together. It reminds me a lot of Agnico Eagle and Yamana taking on Malartic for a gold operation, or it reminds me of Barrick and Newmont working together as Nevada Gold Mines. Do we need to see more collaboration between companies where they form JVs to do it together? Because the scuttlebutt is always which company is going to take it over, but clearly it could be two companies working in tandem.
I think you're dead on. And we may have discussed this on a previous podcast here, but yeah, this is a trend that we'll continue to see. These projects are incredibly capital intensive, highly risky, both technically and in terms of the potential for cost overruns. And even the world's largest miner in BHP, I think will be happy going forward to partner with like-minded groups to push projects of this scale further. I mean, BHP are going to be committing a huge amount of their technical resources to this project. So not only are you seeing companies partner with other groups to push projects forward, but they can probably only commit their resources to one or two of these projects at a time, which is why longer term, I'm very bullish on copper in particular, because even a project of this scale is not going to make a huge dent in global copper supply. It's just too big of a market already. And so you have the big boys already strained internally for technical resources, being able to dedicate the time and money to one and maybe two of these projects at any given time. And then even from the point where you press go, let alone the years that it can take in terms of engineering and permitting and pre-construction activities to get to that point, we're talking 4 or 5 years if the project's executed properly for us to actually get to nameplate production. So there's going to be a huge lag between copper. I would argue the copper price, the incentive price for copper is around $5.50 or $6 per pound. And we could see double that. We could see the big boys get a move on pushing these projects forward. And there's still going to be a multi-year lag, 3, 4, 5 years before we see any meaningful supply come online. So I think that needs to be hammered home. These are not medium-sized gold deposits that, if all goes to plan, can be put into production in 12 months or 18 months. This is a Herculean effort. And I think it speaks to BHP's willingness to work with another partner here rather than try to take it on its own.
Hey, it's just smart business, I think, with big companies with money teaming up just so they don't have all that risk on them. But Matt, what's an investment opportunity on the back of this? Vicuña District, Argentina broadly, does this bring in more interest there? Or other Lundin companies, the ones that are maybe smaller, they're still working, they're still exploring any investment opportunities on either of those fronts?
Well, speculative interests come into NGES, which is another Lundin affiliated company, and likely into Mirasol as well, which probably amongst the juniors has the best looking ground in this district. But I would urge between Jose Maria, I mean, it looks like these two operations are going to be integrated. And so we'll see first production at Jose Maria, maybe at best in 2029. That's very aggressive, followed many years later by production from Filo de Sol itself. Between those two deposits, there's decades of mine life already. So I'd be a little cautious rushing into the nearby area plays. Maybe there is consolidation and maybe it happens more quickly. But I think between the resources of Jose Maria and Filo del Sol, BHP and Lundin Mining have plenty to work with for the time being. More broadly, we'll see if there's a rush into copper developers more broadly, as MJG has significant exposure to copper-focused names with, as of June month end, 36% of our portfolio weighted towards copper. I'd like to think that there'll be a speculative fervor in the aftermath of this deal, but that remains to be seen. I mean, deals of this size in particular take a lot of time to come together. And I do think this could be the starting gun on a bit of an M&A spree, but it doesn't mean we'll see anything next week or next month. This certainly sets the pace, and there are definitely more copper acquisitions to come.
Well, just one more wrinkle in this Chilean belt where there's water are such a concern. I just saw an article out a week or two ago, Matt, where it was talking about the energy prices to produce copper going from 4% to 44% over the next 10 years. So in a decade, they're almost expecting a 10x rise. And I think it's a 3x rise in energy just in the next 3 years. So part of that is desalination plants and all the energy that is needed to take salt water, convert it to water that can be used at mine site and pipe it over there. That is what Lundin Mining is doing at a couple of their projects. Do you think that's a trend that we need to shine a light on, that to get copper out for the energy transition, there's a lot of energy you need just to get the copper out, not to mention all the trucks and all the diesel. But the water issue you brought up is a huge thing for Chile, and it's big in Argentina as well. What do you make of the energy consumption needed to even make these projects happen?
Yeah, that's a key point. I mean, you mentioned the desalination angle. That's especially in Chile. That's going to be a huge consumer of energy. I guess the second variable that supports the point is you're seeing a lot of these companies move to renewable sources to the degree that they can. And that's more expensive energy to produce. These companies are looking towards a future where you'll receive a premium, or at the very least receive social and permitting approval to operate these mines due to renewable sources. But it's much cheaper to power a mine off of a coal or gas powered plant. And that's going to remain the case. So that's a second variable there. A third is just look at the overall grade, the head grades of these deposits. I mean, going back 30 years, the average head grade was close to 2% copper for your average copper mine. We're down to 0.5% and going lower. So you have to move 4 times the amount of dirt that you did 30 years ago to get the same amount of copper out of the ground. That's another variable. And then I would just argue more broadly that we're going to see electricity prices rise over time here. So that's another broader factor that I think will affect this. So that's an important trend that we're seeing. Labor is the most important cost factor for most of these projects, though we are starting to see operations mechanized and automated. BHP actually just announced that their Spence project in Chile is now entirely run by autonomous vehicles, which is interesting. And that may throw a wrinkle into the labor negotiations that are ongoing right now between the unions at Escondida and BHP itself. Just mentioning, look, we've fully automated one of our operations, so that's a point of leverage that we have. But yeah, labor and electricity are the two main cost inputs that investors should keep an eye on. And I would argue certainly on the electricity front and on the labor front for the foreseeable future. I mean, it's a bit of a battle between rising wages and then the deflationary force of automation. So it's a little less clear to me how that will play out. But those are the two cost inputs that investors should keep their attention on.
Yeah, that's a good point on the automation front. But fact of the matter is, look, costs keep going up. Metals prices need to keep going up too, and these things need to get built. So hopefully we will continue to see some successful mine builds, not just in copper, but in a wide range of these other metal sectors. Matt, on to kind of the market aspect of things. When you're looking at the MJG portfolio, when you're looking around the resource sector, where are you seeing some of the best investment opportunities in metals and certain stages of companies within those metals?
Well, I would say from a pure contrarian perspective, on the metals front, I mean, PGMs, nickel, zinc, vanadium, and now probably even lithium, which has had a stunning fall from grace as recently as early 2023, with lithium spot prices off close to 85% over that period. So just wild drawdown in lithium prices. I would say those are probably the most unloved metals at the moment. We're also seeing, it's not nearly as contrarian, but we're also seeing a breather in uranium-focused names. So there's potentially an opportunity there. And uranium is a space that we've had very little exposure to within the MJG portfolio since we sold a pretty chunky position in Global Atomic in mid-2022. So there may be an opportunity to re-up some uranium exposure within the portfolio. In terms of PGMs and nickel, we already have significant exposure to those two metals through Bravo Mining, which is our largest holding by quite a healthy margin within the portfolio. But yeah, I'm definitely positively inclined towards zinc, vanadium, and lithium, with the understanding that the metal of focus holds very little weighting within the MJG investment process when compared to the people, the asset quality, the company structure, its valuation, and other company-specific factors. So I want to make that point clear. In terms of stage, the MJG portfolio is already very heavily weighted towards exploration stage names, whether through explorers themselves or companies operating under the prospect generation business model. And as of mid-year, we were at just under 50% exposure to exploration and PGs. So I will say that the companies that are on our watch list, the 4 companies that I'm most likely to initiate a position in here in the coming months, 3 of them are later stage developers, and one of them is actually a producer, which is pretty rare within the MJG portfolio. So I'm looking to diversify a little bit in terms of business model and maybe move a little bit more towards the developed names, understanding that we already have very healthy exposure to the explorers and PGs, and we'll keep it that way. But as always, I'd advise listeners to focus on quality, well-incentivized teams that they trust and stick with them and try not to get too cute with the commodity of focus or the stage of the company. I think these are our factors to consider, but they shouldn't be the key determinant in any investment decision. So I'll end on that point.
Well, Matt, one more point that maybe tying those different ideas together is to get commodity exposure. Another way you've utilized in your fund is through royalty companies, where you have exposure to many of those metals you named without the individual company risk. So maybe just speak to your thoughts on positioning in royalty companies to gain exposure as well as individual mining stocks.
Well, that's right. I mean, the vast majority of our portfolio, close to 75-80% of our portfolio, are pre-revenue names. So they're either exploring or developing mineral deposits. In terms of our cash flowing names, we much prefer the royalty business model. So that's close to 20% of the portfolio. And if you look at the MJG investor letter, you'll see updates on a few of those royalty names that I've talked about and written about publicly, including Altius Minerals and Elemental Altus. I think if you're investing over long time periods, investing in the royalty names is the way to go, with the understanding when we do get to the later stages of a metals bull market that the miners will outperform the royalty names. But given that we have so much relative risk amongst our exploration and development stage names, I'm quite comfortable to have the royalty names filling a 20 or 30% gap within the portfolio to provide a little bit more stability to our returns. So very much focused on the royalty business model. We do have one producing name within the portfolio, and there's the potential for a second one to maybe enter the fray here in the coming months, but certainly will remain more heavily weighted towards the royalty business model than we ever will to producing miners.
All right, very interesting, though. You are looking at diversifying a little bit towards some of those later stage developers, even maybe a miner. I find that very interesting, Matt, and I always appreciate you sharing your insights and what's happening with the MJG portfolio. Look, there are only so many funds that are focused on this sector, so getting the insights of these sector-specific funds, I think, is very important for investors to understand where some of the larger pools of capital go. And hey, just like that Filo deal, we continue to see companies needing to be backed by large money that can support projects, that can support them even in downtimes, and fund exploration, and then create deals, even partnerships with even larger companies. Everyone, that's the end of our show. I hope you all enjoyed this weekend's edition. Please be sure to go back through our website, podcast, and YouTube channel to listen to all our daily editorials covering market moves and company updates. Matt, thank you for your time. Everyone, thanks for tuning in. I hope you all have a great rest of your weekend.
Al Corlin's firm, A.B. Corlin & Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.